Today, it's time to prepare for the next downturn. Hello again, it's Martin North from Digital Finance Analytics. Welcome to our latest post covering finance and property news with a distinctively Australian flavour. But today I want to talk about the latest IMF report, which is the World Economic Outlook, or WEO. So they say that while global growth in 2018 remained close to post-crisis highs, the global expansion is weakening, and at a rate that is somewhat faster than expected. And so they've released an update of the World Economic Outlook, which projects growth at 3.5% in 2019 and 3.6% in 2020, which is 0.2 and 0.1 percentage points below last October's projections. The downward revisions, they say, are modest. However, they believe the risks to more significant downward corrections are rising. And while financial markets in advanced economies appeared to be decoupled from trade tensions for much of 2018, the two have become intertwined more recently, tightening financial conditions and escalating the risks to global growth. So they've revised downwards their forecasts for the advanced economies slightly, mainly due to downward revisions for the euro area. And they say within the euro area, the significant revisions are for Germany, where production difficulties in the auto sector and lower external demand will weigh on growth in 2019, and for Italy, where sovereign and financial risks and the connections between them are adding headwinds to growth. They say that the US expansion continues, but the forecast remains for a deacceleration with the unwinding of fiscal stimulus. Across advanced economies, they foresee growth to slow from 2.3% in 2018 to 2% in 2019 and 1.7% in 2020. And this softening momentum has provided little uplift to inflation. While core inflation is close to target in the United States, where growth is above trend, it remains significantly below target in the euro area and in Japan. And economic activity in emerging and developing economies is also projected to tick down to 4.5% in 2019, with a rebound to 4.9% in 2020. The projection for 2019 has been lowered by 0.2 percentage points from October, mainly because of a large projected contraction in Turkey amid policy tightening and adjustment to more restrictive external financing conditions. And there is also a significant downgrade to growth in Mexico for 2019-20, reflecting lower private investment. The projected rebound in 2020 is due to an expected recovery in Argentina and Turkey. And the outlook for emerging markets and developing economies reflects the continued headwinds from weaker capital flows following higher US policy rates and exchange rate depreciations, even though they have become less extreme. And across emerging economies, some of the pickup in inflation reversed towards the end of 2018. So overall, they say the cyclical forces that propelled broad-based global growth since the second half of 2017 may be weakening somewhat faster than they expected last October. And trade and investment have slowed, industrial production outside the United States has deaccelerated, and purchasing managers' indices have weakened, flagging softening momentum. While this does not mean that we've started a major downturn, they say it is important to take account of the many rising risks. An escalation of trade tensions and a worsening of financial conditions are key sources of risk to the outlook. Higher trade uncertainty will further dampen investment and disrupt global supply chains. A more serious tightening of financial conditions is particularly costly, given the high levels of public and private debt in many countries. And that is the point. Debt remains the most significant issue that we have still yet to deal with on a global basis. They also say that China's growth slowdown could be faster than expected, especially if trade tensions continue, and this can trigger abrupt sell-offs in financial and commodity markets, as was the case in 2015-16. And in Europe, the Brexit cliffhanger continues, and the costly spillovers between sovereign and financial risks in Italy remain a threat. And in the United States, a protracted US federal government shutdown poses significant downside risks. So then they turn to their policy priorities. And as you would perhaps expect, they are preaching globalization and cooperation. They say, given this backcloth, policymakers need to act now to reverse headwinds to growth and prepare for the next downturn. The main policy priority is for countries to resolve cooperatively and quickly their trade disagreements and the resulting policy uncertainty, rather than raising harmful barriers further and destabilizing an already slowing global economy. The call of Group of 20 leaders to reform the World Trade Organization in Buenos Aires must be accomplished. Where fiscal space is low, fiscal policy needs to adjust in a growth-friendly manner to ensure public debt is on a sustainable path whilst protecting the most vulnerable. They say monetary policy in advanced economies should continue to normalise carefully. The central banks are keenly aware of the slowing momentum, and they expect that they will calibrate their next steps in line with these developments. Macroprudential tools should be used where financial vulnerabilities are building up, and across all economies, measures to boost potential output growth and enhance inclusiveness are imperatives. And lastly, they say, given the policy space for countries is more limited than 2008, multilateral cooperation will be even more important in the event of a sharper decline in global growth, and it is essential that multilateral institutions like the IMF have adequate resources to deal with the rising risks. Now, that may be all good and well, but I think there are 3 points that I want to make. Firstly, the cornerstone of the problem continues to be debt, rising debt, and a lot of that, of course, is in the private sector rather than in the public sector, particularly in the advanced economies. And as we've been saying for a long time, allowing debt to continue to expand leads to greater risks downstream. The second point I want to make is the IMF, of course, comes from a global and cooperative perspective. But of course, around the world, there seems to be a backlash against that from the US and even down through Europe. So I wonder to what extent individual countries are going to push back against the idea of more cooperation. And I guess that's a real concern insofar that it seems to me there is more and more intent to look after your own backyard rather than the broader perspectives of international cooperation. Mind you, I have to say that multilateral trade agreements have not necessarily delivered. So I think we need to be cautious about this global push. And the third point I want to make is that the IMF, as well as other international organizations, continues to preach global growth. But the question I have is that global growth mantra actually sustainable and achievable now? Or have we got to the point where effectively we are consuming too much of the planet's resources to be able to support the growing population that we have and to allow growth to continue? Do we need to actually change track and now take a more sustainable path? Now, a sustainable future may well mean that growth is lower. But if we continue to drive economies around the world based on ever more growth, then we're never going to be able to achieve our sustainable objectives. And to my mind, sustainability, actually in the long term, is significantly more important than growth. And to that end, my own view is that many of these global organizations, including the IMF, have actually lost the plot too, because the quest for ever more growth is ultimately going to be self-defeating. If you like what you've seen here today, please share and like the post, add a comment or question. I read them all. And if you haven't already subscribed to receive updates, please do so to receive alerts when we release new posts. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll talk to you again next time.